Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, I've got special guests in today. In fact, we haven't done this in years, and it's there's been some recent legislation that prompted it. And it's a great way to get the word out there to help protect you against some of the things that are some of the risks, if you will, when it comes to investing. There's enough risk just normally, inflation type risks and market risks, tying up your money, all these different things that we talk about as far as making decisions on what's best for you. You have the normal risk of everyday life. Now we're going to talk about those out there that are, greater than that. And I've got Frank Borger. Am I pronouncing it right?
You are. Borger Gilligan.
Borger Gilligan on. And Frank is the Assistant Commissioner for Securities here with the Tennessee Department of Commerce and Insurance. And then I've also got Krista Clossy, who's the Director of Financial Services, same department, right?
Correct.
Okay. And one of these guys are these are the ones protecting us out there, and they're need to understand if you're concerned about something that you've gotten involved with, if it's on the up and up, they're there for you. Okay, you can call the Tennessee Department of Commerce and Insurance. And what number, in fact, should I put out there, guys, for the if there were contact?
The 615-741-7900.
Okay, so you can call in. They're there to help. They'll get you to the right people and make sure that you can find out. You can check to see if something's legitimate as well. They have resources for that and to help you with whatever concerns you have, whether it's for you personally, whether it's for a family member or a friend. If you're concerned about them, they're set up in place to help you. And we're going to talk. There's some of the most common things, in fact, that we run into. One of them, unregistered products, unlicensed salesmen. Now this is almost like the guy who's walking door to door to want to fix your roof supposedly or stuff, right? So there's some of these are going to stick out a lot more than others. Promissory notes. This is a real easy rule of thumb. If someone's telling you they're going to give you 7, 8, 10% guaranteed, if it sounds too good to be true, it probably is. Okay, if you need to understand, well, how's that going to happen? How's that going to work? Anytime, the higher the rate of return, think of it this way. It's almost, if you think like someone wants to borrow money. If they're a high credit risk, they're going to have to pay more for that money. But guess what? It's because there's a good chance they may not pay it back. And this is the same when it comes to, if you're looking at bonds as an example. We've talked about this. Bonds that pay more typically are higher risk. Junk bonds is an example of that. So there's a higher risk of default, and you may not get your principal back. I talked about this. I think it was Will Rogers that said, I'm more concerned about the return of my money than the return on my money. We want to make sure that you get the best return possible, but we want to also have that protection of your principal. Now, one of the other areas that we get into is oil and gas investments. This is one I've had some personal experience with a client that came in some years ago, and this was through a broker dealer, seemed to be a legitimate investment, but it was really totally inappropriate for them at their stage in life and with the amount of assets they had. It was a much riskier type of investment, more for an accredited investor, someone with $1 million or more to invest, as an example, in liquid investments. And even there, you'd still be buyer beware kind of thing. And in this situation, they got into trouble. The money, all of a sudden, the dividends they were receiving dried up. They weren't getting paid. They weren't able to get their money back, and it turned out that there was an SEC investigation. The company went through bankruptcy. We were able to get a securities attorney involved in this situation, and they were able to get back a good amount of their money, less the attorney's fees. Okay, but by suing the BD in this situation for the fact that it was something they should have never been shown in the first place.
Right. Right. Well, it's really important to not only understand what you're investing in, but who you're investing with. Mm-hmm. So, the first thing you really should do when you're looking to take your money somewhere and invest it with somebody is check that person out or that firm out. And you can do that through brokercheck.org. It's a website you can go to. It's run by FINRA. But you can get the history of the broker-dealer or the investment advisor, any disciplinary actions. It's all there. So, you should check that out first.
And this is, say it again, Frank?
Brokercheck.org.
So brokercheck.org. This is one of those things, again, I hope you stay in fact, I should have said this right up front. Pen and paper handy. We're going to be throwing out some things for you, just like the earlier phone number, which was 615-741-7400. 7400. Yeah. 741-7400. And then brokercheck.org.
Brokercheck.org, but you can always call us as well, and we have that information too.
Excellent. There we go. All right. So now one of the things that we also run into, and I've talked about this many times on the show, there's certain things I'm not a fan of. And I've said about variable annuities is one of those concerns. If I'm going to invest in the market, for instance, I'd just as soon reduce my cost as much as I can. And this is one of the things with variable annuities. We're typically adding additional fees when we're investing in the stock market. So if I'm going to have that risk anyway, that market risk, then I can do that without the variable annuity part of it. So that's one. Now I've talked also, and I know there's some out there that have a lot of variable annuities. I have clients come in, and what I do is I call up the company and I just run down with them and say, could you please tell me what your fees are, what your mortality and expense fees are, are there any rider fees attached to this, if you have sub-accounts, what the sub-accounts fees are, and we'll just add it all up. And typically what I see is 2.5 to, I've seen as high as I think it was 5% at one point. So you typically in that 3 to 4% range is not unusual for the amount of fees. And if you think in how much the investment has to perform to overcome that, it makes it very difficult. Well, REITs is another one that I know a lot of people have done well with REITs, but I've had clients come in where they've had money, they've invested in a REIT, and then they couldn't get their money back out. And the reason is understanding a REIT basically is like a mutual fund set up to hold real estate. Well, real estate's not all that liquid, is it? If you're looking to, right, if you want to get at your money, you need to be able to sell that real estate. Well, in a REIT, that's one of the things, whether it's commercial properties, whether it's mortgages they're holding, these are not necessarily the most liquid of assets. So this is one of those areas with real estate, with REITs, and now we have those that are traded and then non-traded. Let's talk about the difference between those.
Sure. Well, you know, I think the important thing to really understand with REITs is what you just said, is that your money will be tied up. And, you know, that's true really of any investment. And, you know, our number one job is to protect investors and to protect the marketplace. So, you know, we're always very cautious when it comes to these type of products. So you're going to want to check out to make sure, you know, any investment that's sold in the state has got to be either registered or exempt from registration under the statute. So you're going to want to check that out to make sure that it's a legitimate investment. You know, that it's either registered or that it's exempt from registration. Right. So that's basically your starting point. But, you know, with any type of investment, you're really going to have to do your homework and figure out what it is you're investing in. Like you said, if your money's going to be tied up for X amount of time. Because if you're expecting to be able to pull that money out if the market goes south, you may not be able to do that.
And you know, this is one of the things, let's be clear, you know, when we're talking, so you understand, when we're talking about not being able to get your money out, there's differences. So for instance, if you invest in a stock and bond portfolio and the market drops down, yes, you can sell. Depending on what you're invested in, it may be a wise thing to do. If you've got a stock that a company that's gotten into trouble, it may not recover. I mean, or it may go into bankruptcy, and you could lose your investment. So, trying to understand, you know, and but on the other hand, if you're in a very well diversified portfolio and you've got thousands of different companies represented there, those market fluctuations you have to expect. You're going to have, I think, on average, about 1 in 4 years are going to be negative years. So, if you're going to be invested, you have to think in that long-term range, thinking that I'm in this for the long haul. The other part of it is understanding, though, that even in that market downturn, okay, maybe my money's gone down, but I can get my money out. I can take my cash if I want to. This is the same thing with, let's say, an insurance product. If you're talking annuities and you're invested, there's a penalty. Same thing with CDs, by the way. If I invest in those and I want to get my money out, say I take out a 5-year CD as an example, and I want my money in 2 years, I know I'm going to have an interest penalty there. Or the same thing goes with annuities. There's going to be a penalty, but you can access your money. After that penalty, you get what's there, and many times you'll still come out ahead. With a REIT, and we're going to take a break. We're up against it, so I'm going to do this little teaser here. When we come back, we're going to talk about the difference with the REIT related to those, how there's where you may not be able to get your money back out when you want it. All right, but join us here and we'll explain how that works as soon as we return on the Retirement Report.